Real Beach Talk. Today we are honored to have with us Joe McCall from Discount Loans. After a lot of planning today at a sales meeting, I handed Joe a note and said, "Hey, would you be my guest on a show? It's not for 6 hours from now." And Joe stepped up. That probably is an indication of how he would step up for you if you needed a mortgage.
Thank you.
This is going to be question and answer session. We have agents here that will have some questions. And Joe is with Discount Loans. And a little bit about your background, Joe.
First of all, thanks for having me here today. I've really been in the industry for a little over 25 years, in or around banking, mortgage finance, and so forth. Worked for several different companies, being either bank or in the brokerage market. So it really gives me kind of an overall view of the different things that are out there.
25 years old in Florida?
Not all in Florida. Started in Ohio and Columbus, down to Cincinnati, and then moved to Florida 20 years ago.
Wow. What do you like most about what you do?
Honestly, help put people in houses. That's what I've always said. Honestly, it's the gratification of getting that person either their first home or second home, the investment property they always wanted for income for their house or income for their family. Everybody has a goal that they have in life when it comes to housing, and it's really that gratification. There's no other career or anything I've ever seen that allows that to happen.
That's great. You've done a great job with us too. When people are buying houses, they want the best deal they can get.
Sure.
Right?
Yeah.
The cheapest deal.
Cheapest deal.
But there's so many deals out there that seem to be the cheapest deal, but there's so many moving parts to it.
Sure.
If someone is going to buy a house, they generally go out and look at houses, they find one they like, and then they say, okay, well, I know I got 20% down or 30% down. What do I do now? And then they go start searching.
Sure.
Is there any benefit to being pre-qualified for a mortgage?
100%. Really the pre-qualification process, and there's really different levels. We've seen just today, I had from a large bank, a client told me he was pre-qualified, had the letter, everything. Well, they never looked at any of his documentation. They never looked at his pay stubs. They never looked at his bank statements. Well, when all that came in, he was no longer qualified.
So many people would think that by going to a big bank, that'll be the way to go.
Right.
And so they just wrote him a letter. And
if you looked at the bottom of the letter, there was the disclaimer, this is an automated pre-qualification,
Oh, wow.
which basically was just, they, fed in some information, it spit out a letter, and sent them shopping. Unfortunately, it's a very emotional process in buying a house.
Mm-hmm.
So, getting that decline or not being able to buy the house you really wanted really kind of sets you back and your family back emotionally. So really, when you want to do a pre-qualification, you want to make sure when you're talking to that lender that they're going through the full pre-qualification process. First of all, just over the phone, whatever, take the information, get the credit approval, but that's truly what it is. The next step is for that loan officer and or processor to go through all of your documentation, be it income, assets, and so forth.
Is that the difference between pre-approval and pre-qual?
They used to call it a pre-approval. They really did. That was kind of pre-qual, was just kind of credit, and then you moved into the pre-approval stage, which was they looked at your documentation. Unfortunately, in this marketplace, that's kind of over the years, pre-approvals kind of moved away, and now it's just pre-qualification.
Okay, so if I'm going to look at a house and I want a pre-qual, I would be thinking that if I'm going to get a pre-qual letter, then I feel confident that if I find a house, I'm going to be able to buy it. What should I look out for when I do a pre-qual?
The first thing that needs to happen from a consumer and from a real estate. So first for the customer is you need to make sure that you've presented your pay stubs and your W-2s, any documentation they need.
For a pre-qual?
For a pre-qual. So, but they'll do the pre-qual credit approval up front, but you really need your loan officer or originator to take that next step and look at your documentation to make sure everybody, unless you're on salary, you know, if you're hourly, if you receive incentive pay, all those different things in the mortgage industry make differences on how long, averages. So what you think you may make and what the bank says you're going to make are two different things. So that's where you need to work with an experienced loan officer that's going to be able to look at those pay stubs and see that there may be some hiccups down the line that they can be addressed up front. And that can all happen in the pre-qualification process before a contract is written.
Okay, then I was under the impression that if I go for a pre-qual, I could get that pre-qual done in half hour or whatever.
You can get and that's what they term as a pre-qualification now is basically credit approval. Almost all loans go through some level of an automated system, either for Fannie Mae or Freddie Mac. So when you apply for that pre-qualification, your employment income, your assets, verbally, all this stuff you give them verbally, it gets typed in, pulls your credit, goes through the automated system, says yes or no. If you get a yes, then you get a pre-qualification letter based on verbally what you've told me.
Okay, so you're going to pull my credit score.
100%.
All right.
You can't, there are, and just word to the wise out there, I have heard of companies, I've experienced it twice so far from clients, that the lender does what they call a soft pull. And that's an estimated score.
I'm guessing they're not going to disclose soft pull to a client when they call.
Right. The soft pull basically is something like your insurance company would do, right? It doesn't affect your credit score. It's not going to be an inquiry. But that also means your pre-qualification is just as good as the information that they have. So say they do a soft pull and your credit score is a 720. Okay, well that sounds like you can get a loan, right? And that's what that pre-qualification means. But it's really not worth the paper it's written on. Because until it can go through the automated system, because like you say, there are so many variables, until it comes back, you really don't know what you have, to be honest.
Okay, so if you're going to pull my credit report, how does it affect my numbers?
Your first inquiry is going to hit your score per se, normally 2 to 3 points. Okay. For the credit companies, you have 45 days for other mortgage companies. If I pull as a mortgage company, a mortgage lender, you have 45 days for other mortgage lenders to pull your credit and receive no more hits for inquiries. And that's so the consumer can shop.
That's fascinating.
Most people think that every time you pull an inquiry, there's a little ding. The one thing to note with credit scores and pulls is lenders have different models. So you only use a basic model for mortgages, but any updates that happen, say you go to ABC Bank, they pull it, you're a 693, you come to discount, we pull it, you're 685. 3 days later. Well, something on that credit bureau may have updated, right? A balance on one of your credit cards, a payment came in, anything. So when there's discrepancies in scores between lenders, it's not necessarily the inquiry, it's there's new information on the credit file between those two pulls. So
Does it ever happen that if I go within 45 days to 3 or 4 different, I'm shopping, and they all pull it, and there is no outside number, is that going to possibly change more than 3 or 4 points?
According to the credit companies, you have a 45-day window. If you remember, and what this used to happen is you used to walk into a car dealer on Friday or on Saturday morning and go shopping for a car, and you were a 760. By Sunday night, you were a 650. right? I mean, because it used to hit you every time, and every car dealer shotgun it out to 10 different lenders, and they'd all pull credit. And 2 days later, your scores were shot.
Does it happen now?
No.
No.
As long as it is a like pull, so it's mortgage to mortgage, car to car, that sort of thing. But if you go out and apply for a house, 2 days later go out and apply for a car, after that go apply for a credit card, it's going to hit you. Because the score is just a risk model, and it looks like you're trying to accumulate debt because you're trying to acquire for different loan types. Then it won't. I mean, then you'll see the drastic hit to those.
Well, that's a good point. So someone who is applying for a mortgage or wants to buy a house, credit company is going to say, that means that he or she doesn't have as much money as they had before, so therefore we're going to anticipate their credit going down, so we're going to make it go down a couple of points.
Right. So it's anytime you're trying to accumulate debt, it doesn't matter if you're paying off one house or another, a new debt is a new debt. And that's the thing. Credit scores are they used to call them a bankruptcy score, but it's basically just a risk model. That's all it is. So any effect on your bureau or any change on your bureau is going to provide a different score.
So when we're talking to our customers, we ought to say, you're down here searching for a house in Michigan, don't search for a car at the same time. Right? Don't get a new credit card because you're going to make a big change here.
You see a lot of furniture purchases. People get excited about buying a house, or they think they're pre-approved with the car or with the mortgage, so they go out and do a house. Basically, you don't want to do anything from a credit standpoint once you apply for a mortgage. You're done. Don't get a car, don't get a credit card, don't go, rent to own, nothing, because that can all affect your approval.
So it's critical that you keep that 45 days in mind, because in a market like we have right now, without a lot of properties on the market, people are starting to search, and then it's taken a long time. They can't find anything. 45 days goes up. They go back and go to a different bank or mortgage company. Now they're hit again.
Right.
And it takes people 6 months to buy a house.
You really don't want to step into the pre-qual arena where somebody's actually run you through, that sort of thing. Like we talked about, a valid pre-qual until you're shopping, until you're really ready. Because like you say, in this marketplace, sellers aren't letting a lot of people in unless they have a letter. Okay, and that could be why some lenders are going to that soft pull, just throw a letter out there just for fun. But as a consumer, like you said, you don't want to go into a 90-day shopping, event with, your credit already pulled and you're kind of on the clock. And that's the point I do want to make there. Your credit's not only good for 45 days. Your credit can be good for 90 from that bank that pulled it. But if you are going to shop, then you want to determine pretty much which lender you're going to go to up front.
Our real beach talks are designed to be real information for people. And frankly, I've been given the wrong information, because I will say, go and get pre-qualified right away, because that puts us in a better bargaining position when we go to the house.
Right.
So it sounds what you're saying is that it might be better for us to tell our clients to go request a soft pull, so they get the letter and it doesn't hit their credit at all. So if I called you and I said, look, I've checked my credit score, I know what it is, I've checked it a week ago, this is what my credit score is, this is what my salary is, Joe, can you give me a short pull letter?
Yeah, we can. Yeah,
now, I'm not talking about that from your standpoint, I'm talking about it from a buyer that's going to go in and they're looking for a deal, and it may take them 6 or 9 months to get a deal, but we want them to be able to get in the house.
Sure. If you're say you're 720 or 740, your loan officer can ask you those questions. The other qualifications are going to be, asset base or debt to income, or some of the other general parameters that have to fit from a mortgage standpoint. And yeah, you give a verbal pre-qualification without running it through the system. Sure, no, because my pre-qualification is based on what you've told me.
Right. I want the soft pull letter with the stuff at the bottom that says, you know, don't count on this because it's not right. But no one reads the bottom of the letter.
That would be the same thing as a verbal, or same thing as you give them the information that says, yes, it sounds like you.
But you will send me an email that says, basically, based on what you told me,
right,
you would be able to qualify for that. Wouldn't that be a better thing to tell a buyer? In a market like this?
Not if they're truly shopping. I mean, if they're actively looking to place offers, then you want a full pre-qual. You want them to, if they're, like I say, because remember, the 45 days is just an inquiry issue, right? Just so you don't get dinged with 2 points. Your pre-qual is actually valid for 90 days. So if you're actually going to place an offer within the next 90 days, you should do a full pre-qualification, because that's the steps that we were talking about with having your credit pulled, get run through the automated system, get your pay stubs, your bank statements, get all that in to be reviewed up front to make sure there's no issues.
But when I go through the whole thing, how much does that ding my credit?
Just the one pull.
Just one pull. As long as I don't go to another company.
Right. Right.
Wow.
Yeah.
I'm learning something.
So if you shop, if you're going to shop, you want to really kind of determine that initially. Like you say, once you're outside that 45-day window, and worst case scenario, it takes you another couple points. I mean, as long as you're not on, you know, you're 700 or you're a 650, and any changes may affect your rate or your program or your amount down, that sort of thing.
So let's say we find the house, we have the pre-qual letter, we go through getting the mortgage. Until this deal is closed, we probably don't want to pay $40,000 for new furniture.
No, you don't want to make any purchases at all. And that's
got all that?
Because the audit, every bank does audits, and they do final audits. So they do a soft pull at the end. So right before you're closing, they pull your credit again on a soft pull, which just basically gives them information. So if you've had a derogatory event, say you quit making the mortgage payment on the house you own now, or you have a $2,000 collection that pops up in the 30 days or 45 days of processing.
I bought $50,000 worth of furniture, a new Maserati, and I got 4 credit cards and upgraded my American Express to black.
You're not going to close.
And they'll find that out a couple of days before closing?
Pretty much within 48 hours before closing.
But will one derogatory event prevent you from closing?
No, I've had them paid, but I have had a $270 collection pop up that had to be paid at closing that we knew nothing about.
So before the closing happened,
It came through on the final audit. It came through on the final pull. We had one on our bureau. It was nowhere to be seen. And they did their update. Some collection companies updated during the process, and the client had to pay it.
Well, it's perfectly understandable that you buy the house, you're going to close next week, and it's empty.
Right.
And you go and you buy a bunch of furniture because you're going to move in right after you close.
Well,
what do you do?
Well, most people, and the other folks, or a lot of people, run into the mistake, I guess, of rooms to go, you know, or somebody like that. 12 months, same as cash. Well, 12 months, same as cash. I don't have to make any payments. The bank has to count against you.
The whole amount?
They have to put a payment on it. Whether you've got a payment for 12 months or not, they're going to put a payment on it, normally 5% of the balance. If there's no payment required on most loan programs, it's 5% of the balance has to be added into your debt ratio.
What are the chances of other mortgage brokers not knowing this or not disclosing it to potential clients?
It happens every day. Every day. The case in point, the client that dealt with the big bank today, that's what he said. You know, it's like, you got to thank me for being honest. He started at a very high loan amount on the house he couldn't afford, to be honest. But he was working with the big bank. They were, yeah, everything's great. Poof.
So,
and it was information that was there that should have been known. And they just didn't do the due diligence. Me personally, after 25 years, I realized it's a very emotional experience to purchase a home. Everybody gets excited. Your family wants to move. I like to take a few extra steps initially before we get into contract, before we get into, get into where people are, for one, financially invested. Then there's money on the table with earnest money, appraisals that have to be ordered. So I like to address any error or any issues up front that I can in the process. Just try to alleviate that. The mortgage process is fluid, so you can't find every issue, but you can do your due diligence to make it a smoother process.
Well, you mentioned big banks versus mortgage companies, and I think the perception is that the guys that are on the radio and TV are the mortgage companies that are trying to sell you, but it might be better to go to Bank of America or the big banks. What's the advantage or disadvantage of both?
Speaking as an ex-banker, I've done both. Banks have their place. However, banks offer you what they have. Right? You go to big bank A, they have conventional this, that, and the other, FHA, this, that, and the other. The one thing that's drastically changed over the last 10 years is banks, all lenders kind of offered, it didn't matter conventional loan from bank A, bank B, or a mortgage broker A. Didn't matter. Now they have the industry term as an overlay. So what's happened in the last 10 years after all these banks got hurt from writing all these loans they didn't really agree with, but they ended up servicing, okay, is they now put their own guidelines on top of what Fannie Mae would say, or FHA would say, or even VA would say. You can go to 3 or 4 different banks for a VA loan and get 3 or 4 different decisions. They all have their own underwriting guidelines. It's VA backed or based, but they all have, some have more restrictive guidelines on top.
But there's a line in the sand as far as VA and FHA goes, and some of the other banks want to protect themselves more, so they make them more restrictive.
Right. They don't want that type of loan. Maybe FHA will go to 580. Well, this bank only wants credit scores of 620 and above, and now they can do that. So you ask the difference of a big bank to a brokerage. Big banks are going to be able to do exactly what they say they can do. If you don't fit in their box, you're turned down. They have no options. The reason I work in the brokerage industry now is as a broker, you have hundreds of loan programs available. We have about 25 different lenders from across the country that are anywhere from wholesalers to banks to some of the largest lenders in the land, just a different division, to credit unions. Because the one thing with a loan, there's very little people nowadays that fit in the box that they used to, right? It's perfect credit, this, perfect income. Everybody's got a job change, or they're receiving this type of pay, or so forth. And each bank's going to work and deal with that in a little bit differently. So, like you say, there's a baseline, but my job initially, and the processor's job initially, is to look at your situation, what you're trying to achieve, and find the right program, the right bank or lending program that's going to fit what you're trying to achieve.
Okay, well, this is really getting me now, because if I go to a bank, I'm hung up on this credit dinging stuff.
Sure.
So I go to a bank, and that happens to be a bank, and I won't know it, that has restrictive requirements more than another bank.
Correct.
And they turn me down. And then I go to another bank, and now they're going to hit me again for a ding in my credit.
As long as you're within that 45 days, it would not hurt your credit.
Okay. But I get back to the other thing, that very few people start searching for a house. Right now, it's 2 years before someone, when they start looking, to when they pull the trigger on a house.
That's a long time frame.
So that's a long time. So if it's every 45 days and they go in and they click on somebody and
right. No, people get hung up on type of a preemptive score. A lot of people say
like I am.
No, but Credit Karma, right? It's what everybody talks about. But it's free. You can get it. Credit Karma is pretty much a credit card score. Like I say, credit scores are risk models. So you're going to have a different credit score if you try to buy a house, if you try to buy a car, or if you try to buy a credit card. You're going to pull completely different scores for those types of lending because they all have their own modeling that they're doing, each industry. So if you tell me you have a Credit Karma score of 760, depending on your installment or mortgage history or different parameters, your mortgage report may be a 720, maybe a 700. You just don't know until you pull it.
So how does a mortgage broker work different than a bank? It looks like you can give a whole bunch of different products and options.
Sure. And that's really where it is. And also pricing. Everybody's worried about rate, and pretty much down interest rate, all the other.
How much variation is there like right now between rates? If you were to search 10 different lenders.
Well, the thing you have to watch out for is rate. Is just like, say,
additional fees.
Well, fees, and you look for, just like the car loan. Have you ever been able to buy that car that shows up in the newspaper for 10.5? You can't find it, right? So if you look at mortgage rates or you go on the internet and start searching that sort of thing, you're going to find that's a particular 760, 780 credit score, 20% down, loan amount of 400 or above. There's going to be a lot of little, tiers in there of how they got dialed in that lowest rate. Okay, so your interest rates you're going to see are really customized to you. Score is one component of it, but it's how much you're putting down, the size of your loan, the type of property you have, whether it's a single family, two family, condo. All these different things go in to how the lender prices your loan. And it is individual. It's purely custom. If you call and ask me what your rate would be, I've got to go down a punch list to even guess to where you may end up.
Okay, so if I call you, it sounds like I'd probably be better off calling a mortgage broker than going to a bank. Is there any way that you have deals with banks? Or is it just mortgage companies?
Yeah. We work with one of the largest banks in the land. It's Quicken. They're wholesalers.
Okay.
I mean,
it wouldn't be Chase or Bank of America, Wells Fargo, or any of those.
No, those folks don't do wholesale lending like what we do. They used to. They don't anymore. But honestly, if you think from a brokerage to I always equate it to Sam's Club versus a regular grocery or something like that, because your banker has to pay for all that bricks and mortar, all that overhead, everything like that, right? So retail rates are retail rates because they're paying your loan officer, the underwriter, the this, that, and the other, and all the costs associated with banking. The wholesale side of the world, the mortgage company shoulders all that up front, hard costs. We pay processors, loan officers, management. All the bank has to do is underwrite and fund the loan once we find the right program. So it's a much cheaper way for them to do business, to still gain loan amount or gain loans, which is all the bank cares about. They're looking to build their portfolio, buy the right loans that they want, but they can do it through their wholesale channel a lot cheaper.
So a buyer may get a better deal by going to a mortgage company, even though you're going to make a commission on the on the thing.
And they're much more flexible. And the other thing is banks move in and out of the industry. One of our major lenders just started looking for FHA loans because they're trying to fill pools of loans. So they just ran a special for this month that they're taking 0.25% off rates on FHA because they need those loans. And the next month it may be that bank, or it may be that bank, or this bank's looking for loan amounts over 300 with good credit. Then they're going to price those really aggressively. And that's my job, is to look at all those different programs, price those major lenders, and see how your particular loan application fits into which bank is offering the best rate and terms for what you're trying to accomplish.
Joe, what kind of loans are guaranteed by the government?
Both FHA and VA
Those two.
are government backed.
No other.
No, USDA is another government program.
What's that?
We don't deal with it much. It's for rural. They use it out in Pasco.
Department of Agriculture.
Yep.
Really?
Yeah, they're 100% loans for. You can get them out in Brandon,
Like Ruskin.
Ruskin. There's areas.
South of 301.
Yeah, South 301. They're income based. They're 100% financing. It's a great loan. We just don't see a lot of it here. We don't have any USDA areas in Pinellas County.
I've heard that a while back, 5 or 10 years ago, the government guaranteed a very small percentage of loans, and now they're guaranteeing a huge percentage. Is that true?
That's true.
What are those percentages?
Well, if you figure, not sure of the actual percentages, but you figure that both Fannie Mae and Freddie Mac, which are the two largest securitizers for conventional loans, okay, are still in receivership by the government. The government took them over back in the crash because they were bankrupt. So they're still in receivership. The government has not turned them loose yet. So in effect, they're involved in even the conventional side of the world.
So basically, they're non-trustworthy bums that the government is still backing and increasing more and more. So you and I are paying all these
the tax dollars
things
that
that
work.
go bad.
Fannie and Freddie are, and the one thing that is a little different in this marketplace versus others since post-crash, basically, is FHA became, the FHA rule is they want about 10% of the marketplace. Okay, they're kind of structured to be a, first-time home buyer type of lender. That's what FHA was designed for initially, was, to help this certain section of the public. Before the crash, or kind of as the world unraveled in 08 to 2010, they were almost 60% of the marketplace. So as the subprime lenders failed back then, all those people that were doing the subprime stuff and that sort of thing, all those loans pushed to FHA.
So people that really can't afford to buy houses now, we're into a huge percentage of those people that are buying houses guaranteed by you and I. So when the next cycle goes down, we're out holding the bag again.
The only thing that's changed in this, and like I say, this has been I've been through 3 busts, I think, so far in my career, or I'll cycles, is basically the one thing that has changed as where before there was stated income, all this stuff, fog and mirror
Liar
buyouts,
loans.
liar loans, right? If you had the credit score and cash, you can do whatever. They weren't checking where you got the money. They weren't checking if you could afford it. Nothing. The one thing with Dodd-Frank did bring in, that regulation requires all lenders to prove that you can afford the home. But that's why the income side of this is so restricted now. Because federally, they have no choice but to make you prove that you can afford that payment. So as to where we had the issues before and everybody walked away because they couldn't afford, well, they couldn't afford when they bought the house. Now, their ratios are still there, and they can prove, the bank has proven that yes, they can afford that house.
Okay. Speaking of not being able to afford the house, what sort of first-time home buyer deals are there out there now?
Well, the big first-time home buyer stuff, there's here in Pinellas County, well, a few counties, Hillsborough also, is, and a few others around. There's Florida Harvest Hit is a bond program that's available locally. I do not have it.
Did that come out right after Irma? Or?
No, okay, Charlie. Still
Charlie.
around.
Okay.
Still around. However, it is ending this year. It's on its way out.
Now we got Irma, and
So
Curtis hit
it may
come
back.
kicked even harder.
So that is a bond program. We do work with a local bank that underwrites that if customers need that. But as we've talked about before, there's programs as little as 1% down from the customer. You get up to 2% grant from the bank. So
Wait a minute, I put 1% down and I get
2% from the bank.
2% back.
Yes. And you end up with 3% equity in your home, with you only having to put in on a $300,000 home. You put in $3,000, they give $6,000. You end up with $9,000 in equity at closing.
So,
You have to stay in your home for a certain amount of time.
It's pretty math, isn't it?
You have to stay in your home for 5 years once somebody.
No, that's on a bond program, yes.
Yeah.
Yeah, for the bond program to be forgiven, they do have a 5-year window on them, but they're prorated normally at 20% per year. And you really have to research those, and that's the thing. I mean, when you're talking about bond programs, because there is one at Pasco, that they actually do an equity share when you sell the house.
did
So
they get
you have to know
part of the
what
profit?
you're dealing with. Yeah.
Wow.
So you have to know, because remember, these are state-funded programs. They're going to try to get their money back when they can, right? So you really have to work with a loan officer, work with a bank that understands that bond program and knows the positives and negatives. Because all your consumer hears is, hey, I get free money.
Right.
Well, as with all free money, there's issues.
So 1% down, what sort of credit score would you need for something like that? And what's the maximum loan you can get?
I just had a second bank come out with it. They say down to 620. I wouldn't advise that. To truly get an approval, you're probably talking 680 or above. So,
Which brings up a great point. What's the effect of these storms now, in your opinion, on what new mortgage programs may come about? There are hundreds of thousands of homes affected between Texas here, Puerto Rico.
I know it's affected our industry on, like we talked about, appraisals in the process more than program.
Appraisals, because they want to be real clear on what damage there is to a house.
Right, like we went through over the last 2 weeks or ever since Irma, every loan, really in the state of Florida, I think the whole state of Florida except for the Panhandle was deemed disaster area by FEMA. So what that required was every bank, whether you were doing a refinance, a purchase, didn't matter. If your loan did not close prior to the storm, it had to be reappraised, or not reappraised, but it had to be re-inspected for any damage before you could close on that loan. The thing is that even falls over to loans that previously closed, that may be sitting on the bank's books and haven't been sold into the market yet. They still had to go back for all of those and re-inspect those. So it's really put a big crunch on the appraisal market, because all those appraisers have to go back out and redo the job, or somewhat of a job, the second time. They have to go back and see.
So if a bank has certain properties in their portfolio, they got to send somebody out.
They have to send them out on the stuff that's already been booked. Unless it's been sold, that's fine. And all new closings had to be re-inspected. So what it's forcing is pushing the appraisers' timelines on all new contracts or all new business that's coming in, because they're out chasing their tail for all the re-inspections.
So we may have to extend time for closing for some of those.
It's probably smart for the next foreseeable about 45 days, or doing a 45-day either contract, and also a key component, which a lot of contracts we don't see marked, is a 45-day financing contingency. Because if you do a 45-day close, but you're still looking for a 30-day commitment, that's still going to could put your borrower in jeopardy. Just because the bank can't get the appraisal back, they can't give a loan commitment until the value's back on the property. So you may be running into some issues there.
And plus, the appraiser goes out there and finds some damage that the homeowner didn't really know.
Right, or no.
But then what happens to your contract that was all inspected before Irma hit, and now who's responsible for that?
Well, we send out the re-inspection, I think, for the contract. Randy told me, I think the seller is responsible up to X amount of dollars.
Yeah, I think in the contract it says that it has to be in the same condition that it was inspected in previous.
Right. But I did have 2 clients that actually had the home inspector go back out also.
Really?
both upper condos, actually, because there was water that got into other units, like through windows or something like that, and they wanted the inspector to go out to make sure this unit was sound.
Okay, that brings up another point with condos. Are condos harder to finance than single-family houses on the beaches, or
Yes, to be honest.
are the restrictions increasing, decreasing, staying the same, and why?
From a, like we talked about conventional, which is you're paying in front of your standard loans. The difference there, and as a buyer, there's two distinct pieces. A condo project is either warrantable or non-warrantable. And what that means is it's either warrantable per Fannie Mae's guidelines. They have specific guidelines to budget, to investor rentals, reserve, rental concentration, or ownership percentages. There's a checklist that they have to go. If it fits in that box, then it's a Fannie Mae warrantable condo. Okay, that can be done 5% down, just like a single family home. No difference. Going to be fine. Not a problem.
But I found that a lot of these condos don't have proper reserves.
Right. So your big key, and that's what drops them over most. That's the biggest issue we have that kicks them into the non-warrantable bucket. And it's not that it's a bad complex at all. It's just it does not fit the box for Fannie Mae. So what that does is it changes your rates, changes your loan programs, changes your down payment minimums. So really harder to buy those non-warrantables or the non-warrantable projects. But like you said, the Fannie Mae's, and they've got a pretty good solid line on this, is the project needs to be putting back 10% of their gross fees. That's some minor calculations, but basically 10% of their gross fees into their reserve account.
I heard that the state of Florida requires 10%.
If it doesn't matter, and again, this goes back to the crash. They really got hurt here in the state of Florida with condo owners either vacating, not paying their fees. They ended up with a lot of condo buildings that didn't have adequate fees. Then they had damage, then they had issues. So they didn't have adequate reserves. They didn't have, had all these investors or absentee ownership in these condo buildings. So when the market failed, they were stuck with holding the bag on a lot of these projects or a lot of these condos that, were tougher to sell, tougher to finance, and so forth. So they are very, very strict. You can be an 800 credit score if the condo project itself does not meet that list of criteria. They don't care. You're not getting the Fannie Mae loan.
Is there any requirement about not having first floor units in a condo as to whether the whole building is financeable? So I know there's something coming up with flood insurance about.
Yeah, that could be. That's the one thing with the mortgage market. It is ever changing. I mean, monthly we get large changes. Banks make changes all the time. So yeah, I mean, if they've got an issue now, or if they don't have an issue now, you may want to check. But like we always say, if you're either buying or selling a condo, get those bylaws, get your association paperwork, get the insurance on the building. As a real estate agent or as a consumer, you need to see that up front, and you need to get to that 2-year lender as soon as possible, because you'll hear story after story. If they don't get it up front, they're 45 days into the process of the mortgage, and all of a sudden they find out the building doesn't qualify. So, I mean, that's just paramount to try to get that information up front.
So, Joe, let's do a little bit crystal ball stuff. Let's look at what's happened between Texas, Florida, Puerto Rico, the islands, the economy, the government spending money, and let's go down the road 6 months from now, next spring or next summer. Are rates going to go up? They're going to go down? What? I know that's a tough.
Yeah,
After
after 20, 25 years, it used to be if stocks went up, bonds went down, so that means rates go up. right? Money flowed from bonds into stocks. If the stock market got weaker, then the money moved back into safe haven, went back into the bonds, which raised the prices, which
Real
lowered the rates.
estate's doing good, stock market's doing bad, vice versa.
Right now, all over the board. I mean, it doesn't seem to correlate anything like it used to. The baseline for a mortgage is pretty much the 10-year bond for the most part. The 10-year treasury is kind of where that flows. But like I say, when you're talking about mortgage interest rates, nobody knows. And your loan officer doesn't know from day to day. They price every morning at 10 o'clock for the most part. So I've always been a proponent in the mortgage industry. If you like it, lock it. If you don't, take the risk. But the risk is on you as a consumer, because your mortgage company, bank, nobody controls Wall Street or what they're going to do on any given day. So we can predict as much with what information is coming out, but yeah, it's.
Let's say that I'm a buyer of a house now, and I have a high 700 score, and I'm looking to buy a $400,000 little house on the beach. And you're my brother. What should I do? Should I get pre-qualified? Should I find the house first? Should I shop around? Should I go to a big bank? What should I do?
Yeah. I wouldn't mind talking to a couple people. Honestly, as with most things, referrals are normally best. If you have somebody, either your agent or a friend or somebody that's worked with a particular person before, loan officer in particular or company.
What do I ask my friend or this person referred to me?
The first
Or
question.
what do you ask me?
The first question everybody asks is, "What's the rate?" Like I said earlier,
It depends.
it really depends. Until, yeah, I mean, I can tell you, anything. I mean, but and that's the thing with rates. Just to give you an idea, you could be you may be able to get 2.875. It may cost you 7 points to get there, but you can get it.
And buy down your rate.
Right. Or you may take 4.5 and
Would you suggest that at some point? If I had a lot of cash and I'm young and I want to get a 30-year mortgage.
The average mortgage stays open less than 5 years.
Really?
Yes. People either refinance. Life changes too quick nowadays. So you either refinance, cash out, get transferred, want the bigger house, want the smaller house, don't like your neighbor, whatever.
5 years.
It's 40. It used to be 42 months. I think it's up to 48. So normally in a particular situation, and I'm not saying people move in that term of time. I'm saying their mortgage stays open that time, right? So normally it takes about 5 years, 5 to 7 years for discount points to make sense. So if you're going to be in that house/loan really about 7 years or more, then you're going to start, your interest rate is going to start to take effect and benefit you. You're going to be in that house 3 years, get in the cheapest you can. Make as little as you can, take the interest rate, watch the fees getting it up front, as long as you're happy with the payment.
Another crystal ball question. Better to take a fixed rate or a variable rate?
Right now, fixed they're just still fantastic.
They're still low enough.
They're still fantastic. I personally wouldn't recommend an ARM, unless you want to go a 7 or a 10 year, which would, it was a 7-year fixed period or maybe a 10-year fixed period, then terms adjustable. Right. So, but really, I mean, with rates close to 4 or they're at, right around there. I mean, it's going to be hard, like you say, if 2 years from now or 3 years from now or 5 years from now, this economy ramps and takes off and they let interest rates go back to the market and actually
back at 6-7%.
Right, and they'll go back to what's normal, which is 6%.
Mm-hmm.
Right, 6.5, 7. That's the way it's always been. The market's just been artificially low for such a long time. the people are expecting the 3.5s and the 4s, and that's not really in a thriving economy. That's not really the true market rate of a mortgage.
So right now, around 4% plus or minus is what
Depending on your
someone
loan.
can get, and that's not going to hold back people from buying.
No.
So I have a question for you, Joe. If someone is considering selling next year and they want to be out of their house by like June, but they have a 5%, a little bit above the 5% mortgage right now, is it in their best interest to refi if they would qualify for a lower one?
I would say, I mean, everybody's particular situation is different, but I would say no, and the reason being, it costs us somewhere in the neighborhood of $3,500 to close in the state of Florida, between title work, intangible tax, doc stamps, those sorts of things.
It's a lot of payments if you're going to close 6 months.
Right, you're really going to have to move that interest rate to outrun the cost of the refinance. Now, as we kind of talked about, you can either buy down your rate or you can get a credit for your rate. So, not to get too complicated, but you can also receive a lender credit from your bank if you take, say, the market is 4%, and you take a note rate of 4.5. Well, you're going to get a lender credit back for some money, depending on each loan. It could be $4,000 or $5,000, depending on the structure. If you could utilize that to pay those costs, then you could lower your interest rate and not come out of pocket with any money, or not add your principal balance with any money, and you could still lower your payment or still lower your interest. That would be viable. But normally the best course of action to lower any interest, if they're really concerned about the interest that they're paying, is throw one extra payment on the year. You'll outrun any gain of a refinance, to be honest.
Really?
In the short term.
One extra payment a year?
In the short term. If you accelerate or just put an extra $100 or $200, your effective interest rate is going to go down because you're applying principal as you go forward. So you can actually do, I mean, you remember the whole biweekly payments they used to do?
Yeah.
That was basically one extra payment a year, is what it came out to be. And it would take a 30-year mortgage down to 17.
So if you had a 30-year mortgage and you made 2 payments a month, would it be better than having a 15-year mortgage?
Yeah, about the same.
Yeah.
But that's the thing. If you're into an 8-year mortgage, mortgages are front-loaded, right? You pay 2/3 of the mortgage. You pay 2/3 of your interest in the first 30-year mortgage contract. So
Because I know you're not going to keep it for a long time.
So if you're 8 years in or you're 10 years in, you're just getting basically where you pay yourself. So you really have to benefit from refinance if you're deep in your loan.
Okay, this is beach talk, so we're talking about barrier island real
Yes.
estate here. What is the maximum of VA and FHA?
One of the little known fact, FHA would be a huge proponent out here. Your 274 maximum, 74 and change maximum loan amount. So that's not going to help us too much out here. Little known fact with VA, and most veterans do not know this, is VA will do jumbo loans. They will go up. Some lenders will go up to $1 million. Some lenders will go up to $1.5 million. Your benefit is you do have to put money down. A lot of people think the VA, or VA loan is 0 down, first-time home buyer type thing, gets the vet in his house, that sort of deal. They can reuse that benefit. If they have that benefit, even if they bought a VA loan in the past, they want to reuse that benefit. The funding fee changes a little bit, but they can reutilize that their benefit on subsequent houses. From a beach standpoint, if you want to go jumbo or a large loan, any loan amount over $424,000 approximately is what's considered jumbo. So once you move out of the conventional marketplace into the jumbo marketplace, rates change substantially. They're higher risk loans. Down payments change. Credit scores go to pretty much 700 plus.
Even on VA? Yeah.
No, that's what in the standard jumbo market, the credit scores really increase and so forth. If you utilize a jumbo for the veteran, basically you can get the veteran a lower down payment. The price is like a VA, which is fantastic pricing. Still 30-year fixed. They do have to pay the funding fee still.
Which is about how much?
It's loan to loan, and if they've used it before. It can be anywhere from 2 to 3.3%, unless the caveat is if that veteran's receiving VA disability, then it would wait for them. So the VA doesn't charge a funding fee to any veterans receiving VA disability. So, but I did.
So I'm a veteran. I could refinance my house now under VA and possibly get the loan.
VA pricing.
Might have got a customer today.
It's a little known fact. People do not realize that the VA will allow that to happen. Because like I say, everybody only thinks with VA is zero down. So on a purchase.
So what would be the down payment?
It's really a rough calculation. It really depends your loan amount, but
Let's say I won $600,000.
I wish I could do all that in my head. It's basically 100% of the 424, and then the veteran would have to put down 25% of the excess. So just to make round numbers.
100% of 424, so $175,000.
So there your 424 is your loan amount. Let's say you're trying to buy a $624,000 house, right? Like I said, forgive me on these approximates, but so you have 200 grand extra, right? So it would be $50,000 down on $624,000. You're not going to find a jumbo that's going to do that. A jumbo conventional that's going to do that.
So the advantage of watching Beach Talk is you can refinance your house if you're a veteran with Joe.
Exactly.
Can you do 2 VA loans at the same time?
On the same house.
Only if you've been reassigned.
What is that? Oh,
So
okay,
if you're,
okay.
yeah,
You have to work
if you're
Go
active,
to Afghanistan.
Or something.
yeah, if you're active and you get reassigned to a new station, you have as a veteran, you have a maximum benefit allowed to you. And if you say you buy a $150,000 house in Indiana with a portion of it, then that's going to be subtracted away. You may have to put some money down on the second one because your benefit's not fine. But you can't actually carry 2.
Okay, we're running out of time. This has been great. And agents that are watching this now, when you have a client, have them go on c21wizard.com and watch this, because Joe is coming up with stuff I didn't know. And I'll tell you in a couple of weeks if I can refinance my house, which is a great deal. So c21wizard.com. If you want to call Joe at Discount Loans, what's your number?
727-386-9006.
9006.
Yes, sir.
Okay, so it looks like from this talk that if somebody calls you, they can trust you. You're going to give them the options. I don't know about the soft qual or the hard qual and all that stuff, but you're going to take everybody into consideration.
Sure.
Are you looking? Are you going to buy in 2 years? Or how many offers have you made? Have you been pre-qualified or not? A lot of moving parts.
Yeah, a lot of moving parts, and there's that's one thing to remember. I mean, I always joke that it takes 27 people to close a mortgage. I mean, because there's a lot of people involved between the agents, the title companies, the appraisers, the lenders, the underwriters, and the originators, and everybody. It takes a lot of people to help close these loans, and that's the one thing. If you call me, if you talk to me, I'll always try to be as honest as possible on your opportunities, but I'm going to tell you straight. It may not be what you want to hear, but you'll find out if you have it. I mean, if you truly have a pre-qualification, something that's valid.
What's the email address, Joe?
It's joe@discountloans.com.
Discountloans.com. So we can just email you and say, here's Mr. Jones' phone number, give him a call, and you call him. I can attest to that because Joe accepted this challenge in about 30 seconds with a note handed to me in a sales meeting this morning. So thanks so much for being part of this.
Well, thank you.
Great
Pleasure.
Now we know we gotta have guests every week. That was awesome.